Good afternoon, everyone. Thanks for joining us today. Welcome to Miller Value Partners Live Quarterly Update, October 2025. I'm David Yazdan, and I'm joined by my colleagues, portfolio managers Bill Miller IV and Dan Lysik. After updates from Bill and Dan, we'll open it up to Q&A. If at any time you have a question, just click on the Q&A icon at the bottom of your screen, type in your question, and then press submit. We'll try to get to every question at the end. So let's start with a brief update on performance. For our Miller Value Partners Appreciation ETF, symbol MVPA, which is our concentrated public equity ETF, heavily weighted towards small cap and mid cap securities. MVPA has lagged its S&P 500 index benchmark for the year-to-date period through September 30th, but still outperformed it for the since inception period. Now, inception was about 20 months ago on January 30th, 2024. Next is our Miller Income Fund. The iShare ticker is LMCLX. The fund seeks to find undervalued yield opportunities and can invest across the capital structure. Miller Income had a strong third quarter and has outperformed its benchmark, which is the Merrill Lynch High Yield Index, for the 1-year, 3-year, 5-year, 10-year, and since inception periods through quarter end. Now, inception for Miller Income was February 28, 2014. For our Miller Value Partners Leverage ETF, the symbol is MVPL. This ETF implements a proprietary algorithm, including elements of volatility, market direction, leverage, and other variables to express either a bullish or very bullish market view. MVPL has outperformed the S&P for the year-to-date, 1-year, since inception periods, and inception for MVPL was about 19 months ago on February 28th, 2024. And in fact, since inception, MVPL has outperformed the S&P 500 by over 1,100 basis points. And for our Miller Deep Value Select strategy, we're restricted on what we can say here. Eligible investors need to be qualified clients. So if you're interested in learning more, please contact us through our website, which is millervalue.com, or you can contact me directly at dyazdan@millervalue.com. Now let's get to the topics of the day. In our outreach and emails leading up to this discussion, we posed this question: is there still time to capture upside in small caps? We believe the answer is an emphatic yes. And we say the same holds true for mid caps. Our Q3 commentary should be posted today or tomorrow on millervalue.com, and Bill and Dan will likely incorporate some of their observations in today's discussion. Some of the topics they cover in the commentaries and today is the continued market exuberance and capital flows to passive strategies, resulting in passive funds outperforming the majority of active managers year to date. A natural byproduct of this exuberance is elevated valuations for many stocks that may not deserve it. We warn that AI-related spending, arguably overspending, could lead to unrealistic growth expectations. Any disappointment in these expectations can further accelerate a broadening of the market and a rotation out of richly priced securities in favor of under-owned bargains. And we share a startling chart pointing to today's unusually high weighting of stocks in the S&P 500 that are trading above 10 times sales. This high weighting of stocks in the S&P trading at greater than 10 times sales surpasses the level leading up to the dot-com bubble bursting on March 10th, 2000. You'll recall that the year 2000 also marked the start of a prolonged period where small cap value trounced large cap growth. Now, given today's echoes of the year 2000, I'm reminded of the concept of the growth trap, first introduced by value investor Marty Whitman in his October 2000 letter to shareholders. While most pundits were focused on value traps, cheap stocks that stay cheap, Marty argued he'd rather be stuck in a value trap than a growth trap, especially when markets shift and growth investors prove overly optimistic about revenues, cash flows, or earnings. Investing in popular stocks at peak hype can be dangerous when high expectations aren't met. The most damaging growth trap occurs when conviction remains high and a disappointing results are misread as temporary market noise. Investors often double down on dips, compounding losses if the stock is actually impaired or gets repriced significantly lower to a more fitting valuation. This can be far worse for a portfolio than holding a stock that simply trades sideways. At Miller Value, we've built an investment process that seeks to avoid both value and growth traps in our pursuit of market-beating returns for you, our clients. And with that, I'll hand it off to our largest client. Yes, we eat our own cooking in a big way, for his comments around performance, active management, and the risks associated with a concentrated portfolio in pursuit of outperformance. Bill?
Thanks, David. I appreciate that, and I appreciate everyone's time here today. We know that's your most important resource and valuable resource, so we thank you for spending it with us. So with that preamble, David, I want to rely heavily upon the shareholder letter that was posted to millervalue.com today called "We May Have Seen This Movie Before." And in that shareholder letter, I note that the active management industry is effectively in a state of crisis. 21% of active managers this year, year to date, through the third quarter, have outperformed their benchmark. If that holds for the end of the year, that will be the lowest percentage of outperforming active managers in at least 2 decades. I want to note a couple of things here. Active management is a mathematically challenged competition in that you have a pool of active investors that are charging high fees to effectively price securities efficiently. And next to them, you have passive investors who charge much lower fees. And so the active investors get the returns of the market, less the higher fees, while the passive investors get the return of the market, less the lower fees. So in the aggregate, active management will continue to underperform passive management. Why do we do it? Well, because some active managers are able to outperform over the long term, albeit with some volatility relative to their benchmark. I think that there's really 2 ways that this competition manifests itself in active managers' behavior that is not conducive to active managers outperforming in the long run, and it all comes down to herding. So there's 2 ways you see this herding behavior. One is in risk limits. Risk limits prevent the extent to which managers can invest on an active basis outside of the benchmark. So a lot of institutional investors will take their active managers, so you can only invest so much in tech, you can only invest so much in these names. And so the more constraints you put on an optimization problem, the less likely you are to get to an optimal result. And, but it depends on how you define optimization. A lot of these managers are prioritizing near-term business needs. They don't want to see redemptions. They don't want to see people fall too far behind the benchmark. But the more of those active risk limits you put on, the less likely it is in the long term that your manager will outperform. So to actually outperform, you have to take risks that are well outside of the benchmark. You have to be willing to tolerate results that are well outside of the benchmark, potentially for extended periods of time. The other way, and so one other interesting stat on that is that the other way you see this behavior show up among active managers is in chasing what's been hot. And one of our research providers, empirical research, noted that the returns to momentum strategies over the past 6 months have been greater at any time than in 7 decades. Okay, so what does that mean? Only 21% are outperforming. And guess what? Those are the guys that are chasing what's been hot, effectively. And so this is not a great environment for concentrated value disciples. I'm concerned about the eventual offset for these momentum investors, but that's reality. And so you think about, okay, what's been hot this year? Well, it's AI, which is something we've shied away from historically. Astute value investors with insight should have been overweighting AI 4 or 5 years ago. Okay, before the world-changing potential was broadly recognized in valuations in the marketplace. So from our perspective, there is no doubt that AI will continue to reshape the world in the same ways that railroads, telephones, airplanes, and the internet did. But if you look back at the history of those innovations, all experienced speculative investment bubbles, collapses, and eventual consolidations. And indeed, all of these investment frenzies are actually what enabled the insane amount of innovation, right? Because you have tons of capital, tons of energy going into it. It's just very hard to pick the winners when everyone's getting incredibly excited about the long-term potential. And so, one of the most interesting things I saw this quarter, which I mentioned in the letter, is there was a recently released study by Bain, the consulting firm, which actually quantified the amount of revenue and demand that would be required to justify the extent of investment we're seeing today. And Bain found that the ongoing revenues that would be needed to justify today's CapEx investment, the project, what's been going on from an AI investment perspective, they need to reach 2 trillion annually by 2030. Okay, let's put 2 trillion annually in AI revenues into context. 2 trillion in revenues for AI is more than the combined annual revenue today of Microsoft, Alphabet, Nvidia, Meta, Apple, and Amazon. All right. It's also, as the Wall Street Journal noted, more than 5 times the size of the entire global subscription software market today. So, we think there is a reckoning coming here. And interestingly enough, I fed that information and told a well-known AI bot to take a look at it and tell me what it thought. And what I thought was really interesting about it is the bot acted as though I had told it that its child wasn't going to play in Major League Baseball. Its all-star little leaguer wasn't going to play in Major League Baseball, and it said, we need to look at the numbers here. Where are you getting these revenue numbers? Where are you getting all this stuff? And yeah, I mean, we verified it. It's actually right. So I thought that was interesting. Um, so while we've seen extensive competition among active management of late and things aren't going great for active as a whole, all is not lost. And no, you shouldn't put all your money in passive funds. Reason being that some active managers with differentiated strategies will actively outperform their benchmark over extended periods of time, albeit with some volatility. I'd encourage you to take a look on our website at a piece I wrote 8 years ago called Why Do We Invest with Active Managers Again? And it gives you a checklist for how to think about active management, how to evaluate it, who to invest with, and why we still invest in them. The basic point here is that if past is prologue, why don't you find an active manager that has outperformed their benchmarks over long periods of time, has a differentiated strategy, and invest with them instead of investing with passive just because that's been what's hot or what continues to do well in the aggregate. So, with that sort of overall look at active, its challenges, I want to just now dig in a little bit more to the strategies themselves and their performance and how that kind of fits into our own personal performance history of investing. So let's start with the fun one here, which David mentioned earlier is MVPL. I've said this on many of our other calls in the past that I thought that over, if you fast forward 10 years and look back, that would probably be our highest IRR strategy, albeit the hardest to sell just because it's in a leverage strategy. A lot of people don't like leverage strategies for the volatility and potential risk. Uh, but it's done really well. So it's up 27.4% year to date yesterday versus the market up 16%. Um, this year to date performance comes on the heels of being up 24% and 24. I would say maybe even more compelling than those stats is that MVPL is up more than SSO year to date. SSO, for those that aren't aware, is the 2 times levered S&P. Not only is it up 27.4% year to date, outperforming the levered index by 300 bips, the SSO saw an intra-year drawdown of, I think it was 35%, whereas our intra-year drawdown was a much lower 26%. So we're ahead of it with lower drawdowns. I still think that's a really compelling strategy. And one of the reasons we really like this strategy personally is because it mitigates the risks of being a concentrated stock picker. When you only own 30 or 40 names, and those 30 or 40 are names where you like them over a multi-year time horizon, when those names aren't among the top names of the 500 that are outperforming or driving the performance of the index in a given quarter or a year, MVPL gives us an entirely differentiated process by which we can still win. And so, now that we've talked about MVPL, I want to touch on the performance of the income strategy, which has been fine, and then MVPA, which has not been as good of late. So the income strategy is interesting because there's approximately 220 basis points, even after the recent pullback, 220 basis points of annualized since inception outperformance against the investable version of our benchmark, which is the JNK. At a high level reminder here, we're looking for undervalued yield, things with a high level of yield that we think can appreciate beyond and generate a beyond that level of yield as investors come around to our own personal assessment of their value. It's our largest fund. And it's done quite well against the benchmark. Again, the benchmark is not investable, which is a high yield index. And if you look at the returns of the JNK, which is investable versus a high yield index, it's about 100 behind that. So we're still about 100 above the uninvestable cost of capital there. And so I want to note that during that period, since it's been now 11 years, we've had extended streaks of underperformance. And I remember one such streak that came at a particularly opportune time when we had a shareholder board meeting. I think it was 2 years ago, when we were looking to introduce these new ETFs to the marketplace. And one of the fund board directors said to me, "Bill, can you talk about performance?" So it wasn't a very good. It was one of our worst two or three quarters of combined performance ever. I think we maybe wiped out most of our since inception relative returns. It was not looking good. So I went through, but I explained it and I mentioned why we thought it was a good time to invest. And the woman just kind of sat there and nodded and she looked at me and she goes, "Yeah, but I've never seen anything this bad. This is like nothing I've ever seen. You got to explain that. That's a standard explanation. You got to explain this." And so I guess the other directors were more sympathetic to the plight of concentrated strategies. And since that time, we've generated it back and then some. But the point is, there are going to be extended periods of underperformance in all of our strategies, which is what all the academic research shows. If you look at research from Morningstar, Mind the Performance Gap, or Vanguard, called Some Patience Required, all of those studies show that almost every single top performing manager spends extensive time in the bottom quartiles of performance over extended multi-year time horizons. And so I want to help all of our shareholders not become a statistic, namely the statistic that active fund shareholders in the aggregate earn 1 to 2 percentage points annualized less than a fund's time-weighted return because they buy after performance has been good and they sell after performance has been bad, failing to recognize the lumpiness and cyclically competitive nature of capital markets. So I encourage you guys to find a manager whose thought process you like and stick with them and add to them when they're not doing as well and potentially trim them when they're a little hotter. And so with all of that as a backdrop, I'm going to turn it over to Dan, who has a lot of great information on why we are particularly bulled up about our strategies right now. Dan?
Great. Thanks, Bill. Appreciate it. We put together a couple slides. We want to frame similar to what we've done in the past, kind of walking through the equity market in general, what we're kind of seeing and noticing, and then the opportunity set that we think is pretty interesting today. So this first slide is highlights the monthly U.S. uncertainty index, looking back the last 25 years. We introduced this one earlier in the year. And again, if you go back and look the last 30 years, COVID 2020 was the previous high that was eclipsed by the tariff fears back in April when we went up to a level of 700. And we saw the reversion back to historical averages. And we think that's going to similar follow that path as we look forward to 2020, 2021. So it's possible future tariffs could have a short-term impact, but we think the long-term trend of uncertainty actually falls lower over time. Leadership that we remember, if you remember going back to 2020, 21, you initially had long duration equities. Technology companies did well coming out of COVID. That was actually eclipsed by small cap and value late 2020 into 2021. So we saw early signs of in the market starting to broaden in Q3. And I think as we look over the next 6 to 12 months, we would expect a similar trend to kind of play out. If you go on to the next slide, here, we've discussed in the past concentration in the market, and it's really interesting when you start peeling back what's actually the indices and just thinking about, buying the S&P 500. So if you look on the left, the chart on the left side upper box, the blue line's the S&P 500. And so we can see looking at that line, the pullbacks to 2000, 2002, and 2008 and 9, but the long-term trend has been up and to the right for the past 35 years, and obviously, as we know, longer, as the market is up nearly 70% of the time, as Bill 3 used to discuss in the past. The red line, if you look at, which is equal weight versus the S&P market cap weight, when the red line's falling, top market caps are significantly outperforming the rest of the market. We circled in orange on the chart when this occurred in the past, which is the late 1990s. And if you look at the bottom portion of the chart, which looks at concentration, top 5 is in red, top 10 is in blue. You can see how the peak concentration back in 1990s coincided with small pack equal weight relative to market cap weighted actually lagging and troughing. So if we look today, we think we're in a similar time period. The top 10 now is over 40% of the S&P 500. So I think it sets up for significant broadening opportunity in the market over the next couple of years. David had mentioned the intro, the chart on the right, which looks at the S&P 500 market cap, which is greater than 10 times revenue. This subset, we know from past history, all different return streams have been looked at. It significantly lags the market over time. High expectations are hard to actually deliver when you're at that high of a valuation level. Over the past 60 years, it's rare to be over 10% of the S&P 500 weighting. So if you go back and historically and look at that, you can see the dot-com peak where you were at 25% of the index in long duration equities. They significantly underperformed over the following 31 months, going all the way back to where it was almost completely wiped away. In late 2021, we approached 25% before a sharp pullback back to 10% or below 10%. And so as we look at where we ended the quarter, we're now approaching 35%. So the longest duration equities, in our opinion, look pretty overvalued, especially when you start comparing valuation spreads to low valuation and smaller market caps. On the next slide, we look specifically at what's been driving kind of long duration. And this next slide that's coming up looks at technology stocks and the S&P 500 technology sector. And we look at price to sales because one thing that's missed a lot, I think, by the marketplace is cyclical companies, peak earnings, peak valuation. It's even greater risk when there's a disappointment on margins contracting, earnings and cash flow resetting, and then valuation contraction on top of it. Price to sales is a good measure to look at historically for cyclical sectors. And so we can get a sense as what the technology sector looks like historically versus where we're sitting today. Historically, over 6 times revenue, it's rare to see that. We were at 7 times during the dot-com bubble. It peaked at 8 times in 2021, similar to the chart we looked at before, and today we're approaching 10 times. You can see by the dot that's above that, that's the S&P, that's actually the Magnificent Seven, which is at 12.5 times revenue. So again, I think we're sitting today at a point in time where it's interesting that those companies, which historically were capital light, are transitioning to more capital intensive businesses. So again, potentially being a risk of future free cash flow, and maybe not leading up to the expectations of what the market's actually assuming today. The chart on the right looks at the difference of the sector weights of the S&P 500 versus the sector earnings contribution. On the left, financials, which you can see is plus 6%. So with the S&P weight in financials is 13.5%. The earnings contribution is actually closer to 20%, over 19%. Let's go all the way to the right. Again, not surprising, technology sector. The weighting is 34.8%. Much higher, 11% higher than what the earnings contribution is. It's worth noting that the tech sector in 2000, March of 2000, peaked at 34.9%. And we know going back 18 months later, at the end of 2002, the weighting was close to 14%. So again, equity is approaching peak margins, peak valuation multiples. There's high expectations. It makes them vulnerable to any kind of valuation contraction or rebasing of that earnings and cash flow if there's a disappointment on future expectations. The next slide, which is where we kind of lead to us being really excited about the market. It's in plain sight. We think it's being overlooked today. What we've done is we've set up a chart here to look at taking different slices of the market, looking at different equity classifications. The first column, and these are looking at valuation multiples for each row, but the first column is the S&P 1500 Growth Index. The price to earnings multiple looking out 2 years is 26 times. You can see the price to book above 9 times, cash flow multiple over 30 times or near 30 times, enterprise value to EBITDA of 23 times. Not surprising, looking at the last row, the technology weighting is greater than 40%. Second column is the S&P 500. Today, because of concentration in top holdings and longer duration equities, it looks more like a growth index. If we went back historically, it's not diversified as one would think if you're buying the S&P 500. Even the S&P 1500 value, which is the third column, has valuation multiples that are approaching the higher end. We're surprised to see that Apple and Microsoft are actually the two largest holdings in the S&P 1500 value. And as we know, both companies are above 30 times earnings, and you can see the tech weighting of the S&P 1500 value at 24%. So as you move now to the right, what's interesting is the 1500 pure value, so that's the lowest valuation subset. Look at also the lower market caps. The S&P 400 is the mid cap index, and the 600 is small cap. You can see how the technology representation falls to the high single digits. And more importantly, look at the valuation measures, 40 to 80% below the market. So again, as Bill highlighted earlier, the crowding in AI technology companies, it's creating significant risk to passive investors just if you're going to invest in the indexes, given their significant cross ownership between the investment classifications. Investors, if not exposed to lower market caps or lower in valuation equities, you're not diversified in our opinion today. So we think it's a pretty interesting time to look there. And while the S&P 500 is near all-time highs, we see mispriced equities, single-digit valuation multiples, earnings free cash flow yields that are multiples higher than the market in the 10-year bond. On the next slide is the final one we have on the market. We just want to kind of revisit quickly just the small cap market. And it's a little bit hard to see on this, but if you look at the upper right-hand corner, it's small cap rolling returns in red versus the S&P 500. Beginning of this year, we were at a 500 basis point annualized lagging of small cap versus large cap, 90-year trough. Last time we saw those were early 2000. Again, that theme of coming back to the early 2000 time period. And we know small cap dramatically outperformed large cap the following 7 years coming out of the 2000 trough. For small caps today, it's very similar to equities versus bonds during the lows of the Great Recession. If you remember back then, equities 10-year trailing returns were below bonds, led some to question kind of asset allocation in general. In our opinion, and we all know how well equities did versus bonds, since the Great Recession lows. The lower left chart looks at the Russell 2000 within the Russell 3000, and today we're near an all-time low of 4%. It's half of the 30-year average. That's closer to 8%. The top 5 names in the S&P 500 combined make up, their market cap is now more than 5x the entire Russell 2000 market cap. 10 years ago, the top 5 were only 1.5 times. Just shows you how much, again, concentration of market cap in the equity market is on the top holdings. And chart to the right is what we think starts to make why this is different as we look forward. You're coming out of a 2-year earnings recession for small caps. So their earnings are expected to inflect. They're expected to be greater than large caps during 2026. They should benefit from lower interest rates, further deregulation, and there's expectations for about $150 million in the tax savings early next year for consumers for the tax bill that was passed. And so we think there's a potential for further kind of small cap earnings to have tailwinds as we go forward. In addition, if you looked at valuation spreads, which is not on this slide, but small cap value is at the single digits decile versus on a historical basis, which again, relative to large caps, which provides an opportunity for valuation expansion. If we go on to the next slide, Before we get into a name that we're going to talk about this quarter, I want to briefly revisit similar we've done in the past, just two names we mentioned on the last call. So JELD-WEN, the symbol is JELD, share price is near $4.60. The ongoing housing market weakness is overshadowing their multi-year transformation progress, and they're right-sizing their manufacturing and distribution footprint. With mortgage rates starting to move lower, we believe the housing market will begin to recover over the coming year. And more importantly, JELD management team is not waiting around, but actually accelerating their turnaround plan. They've reduced fixed costs by $350 million. They're looking at potentially some monetization of non-core assets in the US and Europe. And if you look at the shares today, they look significantly mispriced. The current market cap is below normalized EBITDA, deep discount to book value. And in addition, they have about $500 million of liquidity. And we think there's near-term maturities are limited. So we think the 2032 debt looks very attractive. It's yielding greater than 10% today. Also, we briefly mentioned last call Neighbors, symbols NBR, near $42 a share. Again, just there was a data point that transpired during the quarter. The company completed the sale of their Quail Tools business for $600 million. Proceeds are going to accelerate debt reduction. It enhances the balance sheet liquidity. Management achieving their guidance this year, ongoing debt reduction. The enterprise value EBITDA on a forward one-year basis should be near 2x, which is an all-time low. The last 15 years, the average is 6x. So the shares look significantly mispriced, big discount to some of the parts, and a greater than 50% normalized free cash flow yield. So now to talk, about the name we're going to highlight this quarter, Bread Financial, symbol is BFH. For folks, they may be familiar in the past. It's Alliance Data System Corp. It was renamed, looking back about 3 years ago. It's currently trading around $55 a share. It looks to us to be a highly attractive, mispriced financial stock. If you're not familiar, the company provides direct-to-consumer credit cards, digitally enabled private label cards, co-branded credit cards, installment loans, and even buy now, pay later services. New management came in early 2020. They completed a multi-year transformation, streamlined the business model, developed differentiated products, expanded brand partnerships, and you have a very experienced longtime industry CFO with a lot of success who joined a couple years ago. He's further enhanced the balance sheet and transformation plan. And if you look back from 2020 to today, capital ratios have improved more than 3x. The debt's been reduced by $2 billion. Direct deposits are up $6 billion. So we think the marketplace concerns lately around weaker industry credit card data are over discounted, in our opinion, in Bread's valuation. Management's enhanced the underwriting past couple years. They have credit reserves of 13%, highest in the industry, and their delinquency rates are running at half those levels. So we think there's a potential for actually a significant release of the reserves as we look out over the next couple years, which would help earnings. And if you look on the slide and see how the company potentially delivering on transitioning to the medium and long-term financial targets, which we think they're on track, success would mean that their tangible common equity would increase to the low to mid-20s, and the normalized earnings power would be $15 a share, which means today you're trading at a 25% normalized earnings yield. On the final slide, which is next, we just briefly highlight the valuation multiple. This is a forward price to book basis. Looking at Bread, the share price is currently at a 25% discount to forward book. If they deliver the financial targets, we think the book value grows by $25 a share in the next 3 to 5 years. And so we think that warrants in the low 20s to be at a premium to book. So the shares look significant, at a significant discount to peers. Management's ongoing share buyback, I think, is going to be nicely accretive to the equity value. And we think this is a very attractive reward risk opportunity within financials. And there's an opportunity for the share price to double over the next 5 years, in our opinion. So with that, I'm going to turn the call back over to David.
Thanks, Dan. So now we'll go to Q&A. Again, as a reminder, if you have a question, just click on the Q&A icon at the bottom of the screen and type away, and we'll get to your question. Bill, I have a question for starters here. We talked about valuations in passive strategies. Do you have a view on what valuations look like across actively managed strategies and how maybe Miller value may differ from the herd?
Yeah, it's always good to remind our shareholders of what they own and why. So we have individual write-ups on a decent amount, most of our holdings, I'd say, on the website, more to come. But we keep ongoing valuation stats and know exactly where our portfolio is at all times. So if you look at MVPA, it trades at 11.6 price to free cash flow multiple versus the market at a roughly 39 times multiple. So that's a 70% discount. If you look at it on an EV to EBITDA basis relative to the market, MVPA is at 10.5 times versus the market at 17.8 times. So that's a 40% discount. If you're looking on a price to earnings basis, trailing 10 times for MVPA versus 28 times for the market. So 63% discount. If you're looking on a price to cash flow multiple basis, MVPA trades at 7 times versus the market at 24 times. So 70% discount. It's roughly the same. It's actually lower for the income fund just because that tends to be a more capital intensive set of names. And so the price to cash flow multiple on that's 4.5 times versus the market at 24 times. And then the price to free cash flow on income is roughly 9.5 times versus the market at 39 times. So we're really optimistic about these sorts of valuations, the management teams, the alignment we have in these portfolios. Also, the other thing, Dan was commenting on size dynamics and why we're optimistic about small and mid. 2/3 of each of those portfolios, so 66%, it's between 66 and 70% of those portfolios are in small and mid cap names, so less than 10 billion in market cap. And so we think those are really compelling places to be, and we're very optimistic about them. So that's where our portfolios are relative to passive benchmarks.
Thank you. Next question is from Antonio in Spain. Is Stellantis a good income stock at this level?
Yes, we think so, which is why we own it. You can see if you review their dividend history, it's a variable dividend. So they pay between, I think it's 25 and 30% of income every single year out via dividend to shareholders. It's come down a lot, but we think the expectations in that stock are relatively low. They've obviously had some inventory challenges, new management, but we think over the long term, this is a pretty compelling starting point for Stellantis, especially relative to peers. And so we do think that's a good income stock. I'll give you another idea since that's an international question. Take a look at UPS. That's a new name for us. It's a decent size of the portfolio, though, at 4%. That's a 7.7% dividend yield, which is even higher than Stellantis' yield at the moment. We really like the valuation on this one. The stock has come down from, well, right now it's about $85 a share, and that's down from, gosh, I think it was 200, got up to almost 240. So the stock is way, way down. The valuation, the expectations are way, way down. This is the dominant small package carrier globally. So they have a set of assets that you can't really replicate. They have great returns on capital, but you've seen a cyclical slowdown, certainly domestically in the US. You've seen Amazon pulling out, or they're backing away from Amazon. So all of those numbers have not yet come through their financials, although they're certainly in estimates. And we really like the valuation here for a dominant world-class company, 7.5% dividend yield, 13 times earnings, committed to the dividend, insider buying. So take a look at UPS as another idea for an income stock, or alternatively, take a look at our entire fund, which has a great collection of ideas like that.
Maybe that's worth expanding on a little bit, Bill, just in terms of how you construct the Miller income portfolio. I know the yield is around 6%. I know it's gotten a lot more concentrated over time, and maybe even an increase in common stock for that growth and income. How do you think about, do you try to back into a yield? How do you think about constructing the portfolio?
Um, Historically, we've tried to keep the current yield above that of the high yield index. I think in this environment, that's a little constraining if you think about the, I don't want to say outlook for bonds and yield, and the potential for increasingly higher rates over time. So we think the better risk-adjusted return here is in equities or things with, potential pricing power over the long term, like UPS. But if you look at the overall portfolio yielding roughly 5% on a trailing 12-month basis, and we have room to grow that yield, I think, in a sustainable way, especially right now because we've got a bunch of names run up that have lower yields on them. We think that sort of level of yield is compelling when you look at the dividend yield on the S&P, which I believe is trading close to I don't know if it's all-time low, but it's relatively low right now at 1 point. So it's trailing 12-month yield on the dividend yield on the S&P is 1.15%. So when you're starting at 5% and you think there's room for upside and undervaluation on those securities, we think that's a pretty compelling starting point for a portfolio.
Thank you for that. This question is a follow-up to that UPS from Robert. Did you look at FDX? Any thoughts between the two when you made that decision?
Yeah, so the starting yield on UPS is better, obviously. I think that the overall competitive position of UPS is arguably a little bit better just because of their scale. And you think about global logistics networks, scale matters. And so, yeah, we did look at both of them. We think that the relative valuation on UPS is much better for a wide variety of reasons, but that's probably a good one too.
Mhm, mhm. Okay. The next question is from Nick. I think it may not be one that we can get into specific names on. It's a discussion around the tax harvesting time of year. How do you guys think about that? Are there any sort of vulnerable names that might get sold off and then bought back after 31 days to avoid the wash sale? How do you think about that in a portfolio like an ETF, where there is some ways to manage the capital gains taxes versus, say, a separate account?
Can you go through that one more time, David, around the tax management issues in the question?
Well, the question is, it's that time of year for tax selling. A lot of names often get sold off for tax purposes, and the specific question is JELD an example of a name that might get sold for tax loss harvesting and then bought back at a later date? I don't know if we can answer that question, but I thought maybe I'd make it broader and just talk about, given that it is this time of year, are you managing taxes in any way? And then I thought maybe it might be different for the ETF versus a separately managed account.
Yeah. So, I mean, I'm not sure that at this point of the year, though, that I haven't done enough looking at the academic evidence to understand exactly when during the time of year that's most likely to be the case. There's tax loss selling candidates. I know that potentially closer to the end of the year, that's the case. And yeah, you bring up a good point around tax management between the ETF and the mutual fund. They're very different. The good news about the mutual fund, the income fund, is we still have tax loss carry forwards in that we can use to offset some gains. They've been shrinking over time, but we still do have some there. Not only do we have them there, we also have some tax loss carry forwards in the ETF, which allows us to be opportunistic and trade in the market on a daily basis and not necessarily create gains for our shareholders. But the more tax efficient way to affect trades is through in-kind redemptions, basically, and ads. So, we can, as that fund appreciates over time, MBPL as well, potentially use those redemption methods to mitigate taxes by, distributing shares in the marketplace as needed and trading that way. So, yes, there are differences. No, I'm not exactly sure we have any tax loss selling candidates at the moment. Maybe Dan has a different set of perspectives on that.
No, I agree with all those thoughts. I think sometimes there's opportunity sets to pick off a couple of companies that might be tax sold into the end of the year that could end up being some pretty good, opportunity sets when you think, especially from a small cap value perspective. But I don't, I look at a lot of our companies, even, they move a little bit with the market. There's company specific drivers that we like longer term, and we're not looking to or concerned per se on the short term, trying to focus more on long-term opportunities. So
Yeah, and I guess it's hard to know when the catalyst hits, and it would be it would not be advantageous if it happens when you're out of the stock for tax management purposes. So I can see that being part of the decision-making process. Another question is just on MBPA and the year-to-date underperformance and sort of maybe elaborating on the prospects. I think when you look at the fund, it's in our opinion trading in aggregate below our estimate of intrinsic value, and so maybe this is a buying opportunity for long-term investors. But I didn't know if you wanted to elaborate more on MBPA and just the underperformance this year.
Yeah, no, I think we did a pretty extensive job touching upon the fact that concentrated strategies will experience extended, potentially underperformance periods. When I went through the portfolio and I looked at the various names and things, you can certainly point things in retrospect. We should have done this differently. We should have done that differently. We sold this too early. We should have held on to that, all kinds of stuff. But there was nothing that jumped out about this particular period from a process perspective that was particularly elucidating. And so, from when I went through the quarterly letter and started writing it, that was as comprehensive as I could do. Is there's a lot of randomness in capital markets over short periods of time, and we can certainly talk about our mistakes till the cows come home. That's part of investing, is narrowing your mistakes, and so we're trying to do that over time. But the reality is there's going to be periods of performance where you don't look like the benchmark. You're not going to perform like the benchmark, and that goes for better in 2024 and worse 2025. And so that's where we are with that, and we're going to grind to do better. We don't put short-term business needs ahead of the long-term portfolio performance. And we're the largest clients in all of these funds, and so we're going to do what we think is right for the fund over the long term.
Terrific. Thank you for that. I think that is the last question. I don't know if you guys had anything else you guys wanted to mention before we close.
I would just say we appreciate everyone's time, effort, and partnership, and continue grinding and putting up numbers in the future.
Great, thank you. And before we close, I just wanted to mention that I'll be heading out to the Schwab Impact Conference in Denver, November 4th through the 6th. So if anybody in Denver would like to get together in the beginning of November, or if you're also going to Impact, let me know. It'd be great to get together with you. That concludes today's Miller Value Partners Live Quarterly. Thank you for your time. Remember to follow us on X and LinkedIn, and our website, millervalue.com. We encourage your questions, suggestions, and other feedback, and look forward to updating you again in January.